The global job market is entering a phase that very few people fully understand, and even fewer are prepared for. What we're seeing right now isn't just another cycle of layoffs. It's something much deeper, something more structural. For years, companies have operated in an environment where money was cheap, demand was strong, and growth felt almost automatic. That entire foundation has shifted, and what's happening behind closed doors inside major firms tells a far more concerning story than the headlines reveal. When you look carefully at corporate earnings calls, internal budget forecasts, and the quiet decisions being made by management teams, a pattern emerges. Companies are preparing for mass layoffs not because they're collapsing today, but because the future they see looks much darker than anything we've experienced in the last decade. To understand why, you have to start with the cost pressures that have been building silently, quarter after quarter. Higher interest rates have made debt more expensive, and most corporations carry enormous amounts of debt. Even healthy companies are now paying dramatically more just to service what they owe. That alone forces management to rethink every department, every project, every line of expense. At the same time, input costs have risen and stayed high, from raw materials to logistics to labor. Inflation didn't simply spike and fall back to normal. It reset the baseline higher. Companies aren't dealing with temporary pressure. They're dealing with a new, permanently elevated cost structure. And when you combine higher borrowing costs with higher operating costs, corporate margins start to compress in a way that can't be ignored. But the most crucial part of this story isn't the pressure companies feel today. It's what they fear will happen tomorrow. Hiring managers and executives aren't just looking at current sales, they're looking at forward demand. And what they see is concerning. Consumers are stretched thin. Savings have dried up, credit card and auto loan delinquencies are rising, household budgets are strained, and discretionary spending is weakening. Companies rely heavily on that spending cycle. When they sense a slowdown, even a slight one, they start preparing long before the public feels it. This is what's happening right now, a quiet, cautious repositioning for a world where demand could fall much faster than expected. Instead of waiting to be forced into layoffs, companies are preparing early. Trimming projects, freezing hiring, and planning contingency cuts. There is also a major shift happening in how companies view labor itself. During the pandemic and the recovery period, workers had unprecedented power. Jobs were abundant. Wages were rising. Companies were desperate to hire. That era has ended. Firms are now overstaffed in many areas relative to the revenue growth they expect. Productivity has stagnated while costs remain elevated. And with new AI tools, automation software, and digital platforms becoming cheaper and more efficient, corporations are beginning to see an opportunity. Reduce labor costs now, automate more roles, and protect margins ahead of a potential downturn. This isn't a sudden change. It's been building quietly for months. And when this kind of thinking takes hold at the top level of corporate strategy, layoffs become a matter of when, not if. But perhaps the most underreported factor of all is the pressure from investors and boards. Shareholders have become impatient after years of volatility. They want stable profit growth, even if revenue slows. They want cleaner balance sheets, and they want companies to signal discipline. The easiest way for management to deliver that signal is to cut costs aggressively. That means job cuts, not because performance has collapsed, but because the market rewards it. When a company announces layoffs, its stock often rises. That incentive alone is enough to drive the next wave of cuts we're about to see. So when you add everything together, the cost pressures, the weakening consumer, the rise of automation, and the demands from investors, you get a corporate environment where layoffs become the logical, almost inevitable choice. This is why so many companies are preparing quietly without making big announcements yet. They're doing internal audits, reviewing non-essential roles, revising headcount targets, and building what they call recession playbooks. These are real documents, and they outline exactly which positions would be cut, which departments would shrink, and how fast those decisions would be executed if conditions worsen. The public sees isolated layoff headlines. Economists see data points. But inside boardrooms, leaders are planning for something much larger, a defensive shift to protect profitability in a world where growth is no longer guaranteed. And once a few major corporations begin these cuts, others will follow. Layoffs are contagious. When one company trims jobs to impress investors, competitors feel pressure to do the same. It becomes a chain reaction. That's why the layoffs we're seeing today are just the earliest part of a much bigger wave that could define the next 2 years. The signals emerging now from major companies reveal a labor market that is weakening beneath the surface far more quickly than most people realize. When firms prepare for layoffs, the process begins long before the public hears a single announcement. It starts with internal adjustments that never make headlines, hiring freezes that quietly extend from one quarter to the next, paused interviews that never resume, open roles that silently disappear from job boards. These are not random administrative choices. They are early indicators that companies are reassessing the economic landscape and positioning themselves for lower growth, lower revenue visibility, and higher operational risk in the months ahead. Corporate leaders are looking at a world where the cost of capital has permanently reset higher. Higher interest rates have fundamentally changed how businesses think about every expenditure. Debt is no longer cheap, and refinancing is no longer guaranteed. This forces companies to protect cash flow more aggressively. Departments that once operated with comfortable budgets are now under intense scrutiny. Projects that looked attractive in a low-rate world suddenly appear too expensive, and whenever a company feels squeezed between rising costs and uncertain demand, labor becomes the first and most flexible lever to adjust. The shift in corporate expectations is even more important than the numbers themselves. For years, businesses were conditioned to expect that any slowdown would be brief and reversible. Today, that confidence has eroded. Executives are looking at slowing consumer spending, rising loan delinquencies, and declining purchasing power with a level of caution that hasn't been seen in more than a decade. This is why companies are preparing for layoffs even before revenue drops sharply. They are taking precautionary steps because the risk of a deeper, more prolonged downturn has become too large to ignore. At the same time, productivity trends have raised new concerns. Many companies expanded aggressively during the post-pandemic rebound, assuming high demand would last. But productivity has not kept pace with payroll growth. As economic momentum cools, firms are discovering they are staffed for a reality that no longer exists. This mismatch is at the center of today's corporate recalibration. Companies are evaluating which roles are essential, which can be consolidated, and which can be replaced with automation tools that have rapidly improved. The shift toward AI and digital systems isn't theoretical anymore. It is actively influencing headcount decisions across industries. Investor pressure adds another layer. Shareholders are demanding evidence of discipline. They want leaner operations, stronger margins, and a clear demonstration that companies can withstand higher rates and slower growth without sacrificing profitability. Layoffs, whether people like it or not, have become one of the fastest ways to signal that discipline. When companies reduce headcount, they immediately reduce costs. That reassurance to investors is often enough to stabilize stock performance, especially in a volatile environment. What emerges from all of this is a clear pattern. Companies are no longer reacting to economic weakness, they are preparing for it in advance. The actions being taken today are defensive, strategic, and deeply connected to broader economic risks that have not yet fully unfolded in public data. By the time layoffs reach the headlines, the decisions behind them will already have been in motion for months. And the broader impact on housing, spending, wages, and financial stability will unfold long after the initial announcement. This next phase is not about individual companies struggling. It is about large organizations across multiple sectors reaching the same conclusion. The economic environment ahead is uncertain enough that reducing labor now is the safest option. That alignment is what transforms scattered job cuts into a widespread layoff cycle. And that cycle is exactly what the global economy is now approaching. The next phase of this shift becomes clear when you look at how layoffs ripple through the broader economy once they begin. A layoff is never an isolated event. It is a signal that financial conditions have tightened enough to force companies into defensive mode. When the first round of job cuts appears, it immediately affects spending behavior. Workers become more cautious. Households reduce discretionary purchases, and savings become a priority instead of consumption. This pullback in demand directly impacts businesses that rely on consistent consumer activity. Retail, restaurants, real estate agents, service providers, and countless small operations begin to feel the slowdown almost immediately as foot traffic and transactions weaken. As demand softens, the pressure moves up the chain. Companies that were already operating with thin margins start to see revenue slip, and the same decision-making framework that triggered the first layoffs begins to appear again. Another assessment of labor costs, another examination of non-essential roles, another round of internal meetings about operational reductions. This is how layoffs spread from sector to sector, not through panic but through basic economic logic. When consumers spend less, Businesses earn less. When businesses earn less, they adjust costs. And labor remains the largest cost for most industries. There is also a financial dimension that amplifies the effect. Rising interest rates don't just pressure corporations, they pressure households. People paying more for mortgages, rents, car loans, and credit cards become far more sensitive to job uncertainty. When they see layoffs happening around them, confidence drops sharply. Job security becomes a daily question, and this psychological shift is powerful. It reduces risk-taking, slows big purchases, and increases the number of people preparing for financial stress. When consumer sentiment declines, the economic slowdown accelerates, reinforcing the very conditions that led companies to cut workers in the first place. One of the most overlooked consequences of a layoff cycle is what it does to wage dynamics. During a tight labor market, workers can negotiate. They can switch jobs easily, ask for better pay, and move into higher earning roles. Once layoffs spread, that leverage disappears almost instantly. Companies no longer feel pressure to offer competitive wages. They no longer fear losing workers to competitors. In fact, they often end up with more applicants than positions. This shift suppresses wage growth at the exact moment when the cost of living remains elevated. As wages stagnate and prices stay high, the financial squeeze on workers becomes more intense, creating a long-term drag on household stability. Another critical factor is what happens to part-time and contract workers. These groups are always the first to be affected, and their decline rarely appears in major headlines. But when temporary staff hours are cut, or contract workers are released, it signals that companies are attempting to reduce costs without triggering public attention. This hidden layer of labor reduction often represents a significant number of jobs lost before official layoffs even begin. By the time full-time employees see cuts, the quiet downsizing phase has already been underway for months. The housing market is also deeply intertwined with layoffs. When workers fear job loss or actually lose their income, demand for buying homes falls sharply. This slows construction, reduces activity among real estate service providers, and cools price growth. In areas heavily dependent on a single industry, layoffs can reshape entire local markets. Rental demand weakens, vacancy rates rise, and landlords begin to adjust prices. The impact is not immediate, but once it begins, it tends to last far longer than the layoff cycle itself. As layoffs expand, financial institutions start to notice rising stress levels among borrowers. Credit card delinquencies increase. Auto loan defaults climb. Late payments become more common. Banks respond with tighter lending standards, reducing access to credit at a time when people need it most. This creates another feedback loop. Reduced borrowing reduces spending, reduced spending weakens business revenue, and weakened revenue leads to further job cuts. These are the interconnected forces that transform a normal slowdown into a broader economic downturn. What you ultimately see is a pattern where layoffs serve as both a symptom and a catalyst. They reflect a deteriorating economic environment, and by reducing spending power and weakening confidence, they deepen that deterioration. This is why economists pay such close attention to forward-looking labor indicators. They are some of the earliest and most reliable signals of where the economy is heading next. And when those indicators align across industries and regions, as they are beginning to do now, it suggests that the layoff cycle forming beneath the surface may be far more significant than the public yet understands. The most important part of understanding a layoff cycle is recognizing what it means for the long-term structure of the economy. When companies begin reducing their workforce, even cautiously, it signals a shift in how they view growth, risk, and productivity. This shift doesn't reverse quickly. Once organizations learn to operate with fewer people, once they restructure teams, once they adopt tools that minimize the need for extra staff, those decisions often become permanent. The workforce that exists after a layoff cycle is not the same as the one that existed before it. Roles disappear, responsibilities merge, and entire job categories gradually shrink as companies prioritize resilience and efficiency over expansion. This change becomes even more pronounced during periods of technological advancement. As automation improves and AI becomes more integrated into everyday operations, the economic rationale for rehiring large numbers of workers weakens. Even when the economy stabilizes or begins to recover, Companies often prefer maintaining leaner teams, supported by technology, rather than returning to pre-layoff staffing levels. This means that many of the jobs lost in a layoff cycle do not return, even when conditions improve. It's a structural shift, not a temporary one, and it fundamentally changes the balance of power between employers and workers. Economically, this creates a situation where productivity may rise while employment remains slow to recover. Higher productivity with fewer workers may look healthy on paper, but it can create deeper inequality and weaker consumer demand. When fewer people participate in the workforce or earn competitive wages, the overall economic engine loses some of its strength. Growth becomes more fragile, and the reliance on debt increases. This dynamic places greater pressure on central banks and governments, which must balance the need to support households with the risk of fueling more inflation or adding to national debt burdens. The result is an economic environment that becomes harder to manage and less predictable. Another long-term effect is the erosion of career stability. When workers see industries repeatedly turn to layoffs as a cost management tool, it undermines confidence in long-term employment. People become more cautious, more protective of short-term financial security, and more hesitant to take risks that fuel economic growth, such as starting a business, switching careers, or making major purchases. This collective shift in behavior can create a slower, more hesitant economic cycle, where both consumers and companies operate with a higher degree of caution. That caution can itself become a drag on growth, reinforcing the very concerns that led companies to reduce their workforce in the first place. The housing market also absorbs part of this structural shift. Without strong job stability, long-term commitments like home purchases become riskier for many households. Even if interest rates fall eventually, a weakened labor market limits the ability of buyers to qualify for loans or feel confident taking them on. This creates a more sluggish housing market in which price growth slows, demand becomes uneven, and regions tied to vulnerable industries see more pronounced declines. Housing plays a central role in overall economic momentum, and when it slows, the effects spread across construction, finance, retail, and local services. Financial markets react to layoff cycles in complex ways. In the short term, investors often reward companies for cutting costs. But longer term, markets are forced to reconcile the reality that fewer jobs and weaker wage growth lead to slower consumption, which ultimately impacts earnings. When the labor market weakens too quickly or too severely, it challenges the assumptions that underpin stock valuations. This doesn't always trigger an immediate market correction, but it creates underlying fragility. Investors begin to rely more on policy support and liquidity conditions rather than strong organic growth. That reliance brings its own set of risks. Ultimately, the long-term consequence of widespread layoffs is the reshaping of the economic landscape in ways most people cannot see in the moment. Layoffs are not only about today's financial pressure. They are about tomorrow's corporate strategy, the future of work, and the stability of households. They signal that the balance between growth and risk is shifting, and that the global economy is entering a more uncertain phase. When companies across multiple sectors independently reach the same conclusion, that maintaining larger workforces is too costly in an environment defined by volatility, it reflects a deeper, more structural challenge. This is the point where layoffs stop being just employment statistics and become one of the clearest indicators of where the economy is heading. They reveal how companies view demand, how households will respond, and how much strain the system can absorb before the next phase of adjustment begins. And when these signals align, they tell us that the changes underway are not temporary fluctuations, but part of a larger transformation shaping the economic reality that lies ahead.